Okay, well, our last and third keynote presentation to conclude the first day, the Deutsche Goldmesse, and you may have noticed that in some of the presentation, the name Crescat Capital. We're pleased that we have a member and the portfolio manager of Crescat, Mr. Tavi Costa, here with us. He will be holding the last keynote presentation, and Mr. Costa has been with the firm since 2013, I believe, and he's responsible for developing always very intriguing and interesting macro models and charts. And if you want to follow and see some of those, follow him on Twitter. But I'm glad Tavi's here to give the last presentation. Tavi.
All right, thanks everybody. Let's get started because I got a lot of charts. So just important disclosures page. You can also find this in our website. Well, I think the biggest debate in the macro environment today, if this is a sort of a mid-cycle issue or a recession, beginning of a bigger downturn. And back in the days, I was looking into a lot of research in terms of leading indicators for recessions. And what I found was a lot of people used to look at 2-year versus 10-year yields, 3-month versus 10-year yields. In other words, at the time when you have a yield curve inversion, you have then a signal for a recession. But what I found is that if you look at all possible spreads of the yield curve, and once you get to a 70% threshold, every time we've had that, we had a recession. So to me, this is a very clear signal of what's ahead. And the second thing that is important is that empirically, once you get that signal of 70%, is what do you do with your portfolio? And one of the best things to do is to own gold and to sell the S&P 500. At some points, this ratio rises because of the S&P 500 falling. In some other cases, it's actually caused by gold. But there are 2 times in history, 1973-74, and also the tech bust, where both legs of this trade worked. In 73-74, it was because it was an inflationary recession, which is quite similar to today. And the tech bubble was because, number one, gold was cheap, and second, we just had a bubble and a speculative environment, which just sounds like what we have today. Recently, we've had, one thing I pay attention to is daily changes in markets, because I think they can be quite telling of what's likely ahead. I noticed the other day that we had a DXY move, or the dollar index, had a big downward day, which was one of the largest days we've seen in history, as big as what we saw back in the Plaza Accord, which was 1985. And after that, we had a bull market for gold, which didn't last too long. It was about 2 to 3 years. The second time we saw something similar was actually during the financial crisis in 2008, which also unleashed another second leg of the bull market, which started in 2000. And then you had a pause in the global financial crisis, and then the continuation of that after hitting those levels. I find it quite interesting that we are seeing something very similar today as far as the daily changes on that. I also think it's important to look at correlations over time, because as you construct and build a portfolio, I think you want to be looking at how things are behaving with themselves. And back in, I would say, 10 years or so ago, global bonds and gold have had an incredible correlation. This is undeniable as you look at this chart. Now, recently, we've had a total collapse of the bond market, which everyone is on top of it, but gold prices have actually held up very well since we've seen that. And why is that happening? I mean, one of the reasons, I think, is this accumulation of an asset through bigger players. Here's another one, Treasury inflation protected securities. Imagine creating a security that is supposed to be protecting you against inflation, and it collapses when you have inflation. That's what the red line shows. And then you have gold. Both also used to actually follow each other very closely, and now you're seeing a collapse of tips versus gold, which is quite interesting. Why is gold holding up so well? I'm young, but I'm old enough to remember when the Japanese yen was actually one of the strongest and safest currencies in the world, and it's not anymore. As you see in the red line, this has completely collapsed. The correlation between the two used to be actually pretty good, and now you're seeing a total divergence between the two, and gold, again, continues to hold up well. What is gold sniffing around? I mean, I've been of this view, and I call this a trifecta of macro imbalances, when you have a debt problem of the 1940s, which is I'm referring to not overall debt only, but also really government debt to GDP. And the second one is a valuation problem. I used this chart a few times, and I think it's extremely relevant for today's environment. A valuation problem that we saw very similar to the tech bubble. And the third one has to do with the inflation problem. So you got debt, valuation, and inflation. The three aspects of something that constrains policymakers from acting and not in preventing inflation from infiltrating the system over time, and why we believe as well we're entering an inflationary decade. There are three things going on right now. You can see the correlation is also undeniable. You can see here US dollar interest rates and financial conditions. They're all the same. They've been moving the same way for the last 2 years, basically. And I think it's just, you can't really have this moving forward. I mean, I don't think the economy can really sustain this level of tightening of monetary conditions without seeing every 2 weeks a new institution that fails and is swimming naked, as Warren Buffett likes to say. Here is interest payments by the federal debt, and this is not assuming that they're going to be rolling their debt at about, call it 4%, 3.5%, 4%, which is going to be the case now. So this is for the last 12 months. You can easily see this number, triple from here, just on basic calculations on math of what it's going to look like. Right now, we're seeing a lot of the debt actually being issued in the short term. This is going to be a huge deal. It's about 2% of GDP right now. It could easily be about 4%. That is not assuming we have a contraction on GDP. What if we do have it, which I'm a believer of that. And then I think the percentage will be much larger. We've seen as well global central banks' assets. I think a lot of people have been using charts similar to this, which, I guess you don't need to be an expert of markets as long as you know what central banks are doing, because it's the same chart. Now, the issue what I have with this chart is that the red line is overstated. It's saying $29 trillion, and $9 trillion of that is the Federal Reserve. The Fed doesn't hold $9 trillion of that. The truth is, if you do it on a mark-to-market basis on accounting technicality, actually, they've lost somewhere close to $1.5 trillion of value in their balance sheet. So the tightening has actually been larger than what's been recorded or reported by other people. So you've got this issue now, a recession or inflation, and he picked both. And the second thing is the classic, stagflationary environment. Now, the problem being the Fed is the one who put themselves into this corner, in my opinion. But the biggest issue to me is in the consumer side. So let's talk about the consumer for a second. Mortgage rates are at the highest level since we've seen in 2001, as you can see in this chart. That's creating a buying conditions for houses to collapse completely. So you're seeing record lows in this number, which is lower than another stagflationary environment, a classic one in the early 80s and late 70s. This is worse than that. That personal savings is also collapsing, so it's at very low levels, about 3.1%, which is quite interesting. So consumer is running out of cash at some point here. And you got the wages growth in real terms is also collapsing, as you see, not collapsing, but not growing as fast as inflation. That's assuming the inflation they're using here for a gauge is reliable, which I'm not going to get into that. So what does that mean for corporate earnings when you have consumers getting squeezed? Well, it means most likely we're going to see a contraction of corporate earnings. And right now we have, if you look at the Wall Street estimates, we're estimating about 30% increase in earnings. It's almost laughable when you look at this chart, because I have a very strong view we're probably going to go the other way. Now, 1970s, we've had 3 waves of inflation. A lot of people have been talking about that now, but what not a lot of people talk about is the 3 waves of unemployment rates that happened right after the wave of inflation. In average, they take about 2% after you see inflation rising, you tend to see unemployment rate begin to deteriorate. And that is also linked to the corporate earnings side. So consumer gets squeezed, then you have corporate earnings collapsing, and then finally you have the labor market starting to have issues. That's about to play out. U.S. job openings, as you can see here. You can also do this chart with many other measurements of jobs, some that come to my mind. But job openings if you compare with other times like we saw back in the global financial crisis and the tech bust, so excluding the COVID crash when we had the lockdown, this is pretty significant what we're seeing. And yes, we're coming off very high levels, so that's the elephant in the room. But I think the trajectory is that unemployment and labor markets are actually going to start deteriorating. Inflationary periods, I believe we're entering one. I'm not going to get into the waves of inflation. I'm just going to say that probably we're going to see higher lows over time here. And if that's the case, what does it mean to equity markets? Well, here's the performance for equity markets during inflationary decades. It tends to be pretty flat, actually, in nominal terms. In real terms, it's quite negative. But the difference between today and the 1970s and 1910s, and note that 1940s, it's not my choice. As you can see, it wasn't CPI annual rates average for median for the whole decade wasn't anywhere close to the 70s and 1910s. But you can note here as well, the valuations in the 70s and 1910s was nowhere close to what it is today. Here's just one example, tech stocks versus S&P 500, very close to what we saw back in the tech bubble. If you think this chart is old, I literally just built this chart yesterday. It looks like a head and shoulders there on the right side, but I'm not going to get technical. To me, this seems like a classic speculative environment that is at its end, not at the beginning. We've had a decline in equity markets recently, which is making it, for a fund like us, it's making it harder and harder to short the markets. But you can see the market cap to GDP is still really, really high. We're now retesting the peak levels of the tech bubble. So what does it mean? What is the roadmap? Well, venture capital index is down 62%. It's at the March lows. Let's see other ones that used to be the leading and the darlings of the last cycle. ARK Investments, everybody talks about that, but now it's at March lows too. Chinese stocks, they were also the darlings right before coming off of the pandemic. They were performing very well. Now we're below March lows, even though we had a actual bounce recently. DocuSign, this was one classic software stock that was doing very well. It was worth about $50 billion at some point, and it never made any sense to me. But today you can see here below March lows. Meta, Facebook, well below its March lows as well, even recently after the bounce. Amazon, who would have ever thought that Amazon would be at the March lows of 2020? Here it is. IPO index. This is just a Renaissance IPO index in US dollars of US companies. And you can see also basically retesting March lows. Non-profitable technology companies, all the companies that make no money when you have cost of capital rise. You don't need to be really smart to figure this one out, but yeah, they collapse to March lows right now. And now you have the question, what does it mean if everything else is going to retest the March lows? I think there's a possibility of that. I mean, I work with probabilities, not certainty, and to me, I like the odds right now in terms of shorting some of the things, and I'll talk a little bit about that. So that would imply a 40% decline in the NASDAQ or a 44% in S&P. Which to me, I think a lot of people wouldn't believe that that's really possible. Credit spreads is one of the cheapest things I've ever seen. Credit spreads right now, 1.5%. That's just a difference between yields of corporate bonds versus treasury yields, which means every time you have a big risk event, what happens is credit spreads blow out. We haven't seen that yet. NASDAQ is down somewhere close to 30%, and credit spreads remain actually very low levels, and I don't think that that's sustainable. So that's one of our shorts is on corporate bonds. Mega cap stocks, no one really paying attention to this, but mega cap has actually been underperforming the overall market. Look at S&P 500 equal weighted, and you're looking at the ratio between mega cap versus that, and it's been collapsing recently. What does it mean? I think this is not the end of a trend, it's the very beginning of one, and why I like to be short mega cap. One example is Microsoft. It is a short that we have in our portfolio. And you can see here free cash flow yield in white versus the red line, which is just the price of Microsoft stock. And you can see the free cash flow yield is today just as expensive as it was back in the peak of the tech bubble. So I do think that there's a lot more to go here in terms of a company like this. Revenue growth. It's the first quarter that we've seen a decline in revenue growth, which to me is another very telling part of it on the fundamental side. Barron's cover, literally right at the peak of the market, at the end of 2021, they put out this cover that said, the unstoppable rise of big tech. They nailed the top. And I collect newspapers. I certainly collect this one, and I have now. I want to show my grandkids one day. Here's a difference of FANG stocks. So let's just look at FANG stocks are all behaving differently, even inside of this small number of companies. Here's Apple in the green blue line at the top versus every other FANG stocks, basically. Apple is one of our largest shorts today. I think if you think about a company that would get hurt by deglobalization, I think Apple is certainly one of the top candidates that has benefited from very cheap labor and other benefits of a globalized environment. This is all, when you think about it, is really comes into growth versus value transition, which a lot of people like to talk about as well today. But this is the beginning of a trend, not the end of one as well. While we've seen a lot of value stocks actually perform better than growth recently and growth collapsing, I do think this is the beginning of something. And likely involved with the cost of capital, where cost of capital is getting elevated, and most likely this trend is likely to persist. And one of the things you see is excesses in growth side and some very cheap things in natural resources. Energy today, you don't buy energy stocks because of dividends, but some people do, I guess. But you buy real estate for that. You buy utilities for that. And today, energy actually has the highest dividend yields we've seen actually across all the sectors in S&P. My issue with energy nowadays is energy was a very large percentage of our funds in the last, especially in the last 12 months. I wouldn't say very large, but it was very significant. But we've had two back-to-back years in energy. One was a 50% increase in 2021, and then now 2022, a 60%. It's going to be hard to maintain those types of returns, but they're still historically cheap, believe it or not. Very, very cheap companies, and some of them being valued like they're going to go out of business. And maybe they will. I don't think they will. It's not my opinion. So we hold a position smaller than what we used to have. Look, I don't even know why I go through all these charts. I think this chart should be the only chart we should talk about, and you should have this every day as you wake up and just think about, how do I do that versus not that? And that means buy commodities versus short equities. Some people will short equities in different ways. We've been doing a lot of put spreads at this point just because the market has declined already somewhat, and things are getting harder to find that exposure, harder to get exposure to something asymmetric. Mega cap is an interesting one that not a lot of people focus on. I'm on record for talking about softer stocks in 2021. I'm on record right now for mega cap. I think mega cap is going to look very different in a couple of years. Commodities, I think you can pick your side. I mean, I believe mining is the cheapest side of all this, especially right now, and therefore why we launched a fund to deploy capital into the mining space. And people say, well, you have such a bearish outlook. How in the world that's not going to get caught up with the rest of the market? Well, this is not 2008. And this is also not what we saw back in 2014 or so when oil markets were at the peak. And you can look at that very clearly on the CapEx cycle of this. But you should adjust it for GDP. Because $10 million spent in the ground back in 2008 is certainly not $10 million spent today. And so if you adjust for GDP, we're at the lowest levels we've seen in history. Commodity producers today paying more dividends and doing more buybacks than what they do in CapEx. This is the type of stuff that you see at the, not at the peak of a market, certainly more at the bottom. It's the excessive way of attracting capital to make your shares more attractive. I remember coming up with the CapEx charts. I'm very proud of that chart, the CapEx charts, 2 to 3 years ago, and I thought that became one of the most important charts and data sets that you should be looking at. And when you think about what's the next chart, I think it's this. It's the manufacturing of GDP as part of GDP, not just in the US. We're going to see this in Germany, in France, in Italy. Everywhere that is a developed economy will try to avoid their reliance on places like China. And as we see that, the percentage of manufacturing relative to GDP is going to increase. This chart, I thought this was going to bottom when Trump came in. But that was just my opinion, and it didn't happen. As you can see in this chart, we're still very close to a bottom there. It used to be 28% of GDP back in the 50s and 59, and now we're close to 11%, below 11%. I think we're going to head higher, and that's going to be the next wave for commodities, in my opinion. Remember when China entered the WTO back in 2000? Well, they had to rebuild their whole, or build their whole country in order to become the manufacturing plant of the world. I think the same is going to happen in other places like the US and Europe and other developed economies.
70-year term?
This is, yeah, it's a pretty long, yeah. Metals and mining, you look at the PE ratio today, it's as low as 2008. So what's the relation here? Is, well, I'm long commodities. I like commodities over long term. So one of the things I like to look at is fundamentals for companies in general. And I like to look at the metals and mining space. And it's very interesting. You know, we're close to the 2008 bottom here. And back in those times, our earnings are completely collapsed, and along with prices. And today you have earnings actually holding up very well, while prices are, you know, in the dumps. And so to me, this is an incredible opportunity to be able to deploy capital in a space that I think it's historically cheap. Well, let's look at one company, Barrick, which is controversial. Some people like it, some people hate it, but it's undeniable. It's one of the largest companies in our industry. And one of the things I find it interesting is looking at free cash flow yield historically, and you can see here other times that we've had Barrick being this cheap. Was right at the bottom of 2015 for precious metals, when I believe this company actually went up 3 or 4-fold during that time, and also during the March bottom of 2020. And here we are today again. I really believe that Crescat has never been with such a large exposure to precious metals. This is the biggest we've been, FYI. Newmont mining dividend yield. You don't buy Newmont for the dividend, but again, maybe some people do. But it's paying the highest dividend that we've seen in the history of the company, at least in the data that we can find that is public. It's about 5.8%, which compares that with most utility companies. None of them pay anything close to this. Silver recently had its worst year in 30 years. And this was a chart that I put out about 2 months ago, and now silver has been going higher, but I'm still proud of this chart, so I wanted to have this here. And I like this chart because I think the worst is behind us, and I really do. I've shown some other charts. I was speaking with Claude this morning, and he talked about the daily changes on the GDX, and I said, oh my goodness, he's stealing my presentation. But this is silver prices daily changes. And it's incredible. The last time we've seen a daily change like we saw the other day, which was close to 10% in one day appreciation, was in 2008 in November. And we saw a couple of those, as you can see in the chart. And that was the bottom for precious metals. You can ask Claude for the mining daily change that he was talking about, because that's his chart. But one thing I find it interesting is that silver has really lagged commodities, and lagged for a while. Can you imagine if we have a catch-up here? I mean, this could be, silver could be trading easily at $40 an ounce here. I think that's just maybe a roadmap. Maybe I believe that we're going to see much higher prices than that. But I do think there's a catch-up to be done here in silver relative to other commodities. So we've been trying to allocate more capital towards that and remove a little bit of the other commodities exposure that we have. Agricultural commodities look kind of interesting as well in a more technical sense. You look at this breakout from a pretty long resistance. This is a quarterly chart, so this is going back to 1995. And recently we've had this breakout on the agricultural commodities chart, which I think it's sitting on support right now. I love this chart. I think we're going to go higher. If you look at the 70s, agricultural commodities was a great investment. And that brings me to Brazil. Yes, I'm from Brazil, and I was always a skeptic about it. I hate it. I always thought Brazil is the most corrupted place in the world. I'm probably still right about that, but it is cheap, and things are getting way too cheap. And when I looked at Brazilian stocks, what they've done since the global financial crisis is that they have done nothing. They've gone basically sideways, while the S&P has gone up about 7-fold. And look, this is what happened during the bottom of the tech bubble. Brazilian stocks is the opposite, went up about 18-fold, while equity markets in the US didn't go sideways, but certainly went, well, not up as much as Brazilian stocks. Here's just a ratio, Brazil versus US stocks, both in US dollars. And you can see magically, this is retesting exactly the same point that it did at the bottom of 2000. Maybe we're going to go lower. It's not my view. I like to buy things that are cheap. And right now, I do think Brazilian stocks deserve a sort of what I call the Lula dip, which is as Lula came in, we were going to see a sell-off, and we did. Well, we bought some stuff in the last couple weeks. I was able to buy some banks. And I'm looking forward to the following months. And I wouldn't carry a long, very large position because I do know how volatile this is, and it's unnecessary. I think it's very asymmetric as part of its profile. Here's just free cash flow yield analysis between the two, and you can see here the differential is as cheap as it was during other times that we saw a bull market for Brazilian stocks. You never know what the real trigger is, but you want to be accumulating shares when you see things like this, and so it's very cheap right now. One thing I love is in the rate market. Just look at the FX market between Brazilian real versus the Japanese yen. Here is the deal. It's a commodity exporter versus a commodity importer. I love that idea. I want to be long commodity exporters versus short commodity importers. And this is this chart right here. BRL versus JPY, and it looks to me it's going to break out from this line, and it's going to go a lot higher. We're not long the Brazilian real, we're long Brazilian equities, just to be clear. My favorite chart, though, is Brazilian real versus Chinese yuan. I know some of you in the room have a different view about China that is maybe more positive. That's certainly not my view. And I've been of that view for the last 5 years or so. And in my opinion, China is facing a real problem that is related to its credit imbalance that it has built over the years. This is just a growth in assets, but growth in assets coming from nothing might not be as relevant. What about banking assets to GDP? What about foreign reserves relative to its M2 money supply? What about its collapse in the housing market, which is way larger than it was in terms of size relative to what it was in the US? I think those are bigger questions. And on top of it, I believe strongly we're entering an inflationary period where I don't want to be long net importers of commodities. I don't think those countries are going to perform very well in the future. And I don't think the currency markets are pricing this accordingly. My very final chart is going back to 1993-94 when China had to restructure their banks, and we saw a devaluation of the Chinese yuan of 33% in one day. That would be unimaginable today. I don't think anyone is thinking that this is possible. And I'm not saying it's going to happen. I'm just saying I think the probability is larger than what it is today in the markets. And so basically, if I own a bunch of commodity-related names and a lot of precious metals, along with being short equity markets and being long tangible assets really in the most overvalued currencies in the world, one of them to me is the Chinese yuan along with the Hong Kong dollar. So that's kind of the idea. We're long commodities, we're short equity markets, and we look for the most overvalued currencies to also hedge on that side. With that, I'm done. If you guys would like to see these charts, just take a picture of this and you can send to him, Merrick, and he will send to you this presentation. Thank you very much. And Kai, thanks for having me in this very nice conference. I'm having a great time, so thanks for having me. Shoot.
Can you imagine just the devaluation of the Chinese currency without the Hong Kong dollar?
Go. Yeah.
Right here?
No, you got a microphone. I don't. So I need to use this.
Well, look, we're short both. And I don't know if they're going to happen together. I don't have that answer, but we're short both. And I think the cost for shorting the Hong Kong dollar is way cheaper. And you can get, I don't know, I think we're somewhere close to, you can get it up to 800% of notional exposure for nothing. I mean, it is that cheap. And that's because it's pegged. And obviously, it has been pegged for many decades, and it's a little bit of hubris from my end to say that it's going to break right now. But knowing of what's happening in China, I like the odds, and I think that's not accordingly. But I'm not answering your question, though, which is if it happened together. I don't know. That's a good question. Do I need to be right about that? If one of them happened, I'm happy. Yeah. But, yeah.
Fantastic. Awesome. Tavi, thank you so much. What an amazing keynote. I caught most of it, actually. So
Thank you.
It was fantastic. Thank you so much for coming on. And Tavi will be around tomorrow as well. If you have any more questions, I'm sure you can just jump him outside. And he'll be happy to answer your questions.